Hello, everyone, and thank you for taking the time to join me. My name's Jim Penna. I'm the Manager of Retirement Services here at VectorVest. I'd like to take a few minutes to talk to you about a topic I believe is very important to all retirement-minded investors, and that is the ability to generate incomes through a good quality dividend growth portfolio. So I'd like to take a few minutes and take us into the program and have us take a look at, I'm going to start with, I read an article recently about Warren Buffett and the top dividend stocks and the amazing, staggering numbers of the dividend payouts he gets, right? But what I'd like to do is go into the VectorVest program and just share with you first what the Oracle of Omaha does to generate ridiculous numbers of dividend payouts, and how you can use the VectorVest program to help you find some good quality dividend paying stocks as well. So the first thing I'd like to do is, if I go to the Viewers tab in the VectorVest program, I've created a short watch list of the top, the half dozen stocks that Berkshire Hathaway owns, Mr. Buffett owns, and these are his highest dividend payouts. And I just wanted to walk through them quickly, put them through the VectorVest test of analyzing and taking a look at these. Begin with Occidental Petroleum. Is listed at the top here. We just have them sorted in the VectorVest program by the VST, or the Value Safety Timing Indicator. It's our flagship indicator on how we rank and analyze stocks overall. It gives a fundamental look, the relative value and safety, coupled with RT, which is the relative timing. That's our technical indicator. And so we roll those into one master indicator, and that's how we sort them here. But we have a lot of information on the underlying stock. If you scroll over on the spreadsheet here, there's all kinds of information, but there's a certain portion of this I'm going to focus on here today, and that is on the dividend information. So we'll start with Occidental Petroleum, and this is a huge holding for Mr. Buffett. Now, the difference here is that we're looking at the dividend information for the common stock. Just to be clear, for this particular company, for Occidental Petroleum, he owns the preferred shares, which pay out a bigger number. But still important to take a look at the company. In the VectorVest program, and specifically for dividend-paying companies, I think there are important numbers that we have to look at. Number one is earnings growth rate. So the GRT in the VectorVest program is earnings growth rate in percent per year. Okay, so that's what we're looking at. So Occidental has a 35% earnings growth rate per year, which is pretty darn good, right? It's earnings per share at $3.39. And then I have these strategically lined up here to walk through how we analyze the dividend side of a stock. So when we're looking at quality dividend stocks, there's some rules we like to follow. And number one is to make sure that the company is not paying out more of a dividend than they can afford. Right. Our goal is to look for companies with a long history of not only paying but growing those dividends. What you folks may know are referred to dividend aristocrats, right? 25 years or more within the S&P 500 that they've not only paid but grown their dividends. So I'm not sure all of these fall into that category. I know that Coca-Cola does. We'll talk about Coca-Cola in a minute. But here with Oxy, we're looking at an earnings per share of $3.39 per year and a dividend payout, in this case of only 52 cents annual dividend payout. Now, keeping in mind that Berkshire owns the preferred shares, which pays a bit more. So that's a good comparison, though. We look at earnings per share versus the dividend. Another way to look at it in the VectorVest program, we will show you the earnings yield. Okay. At 5.93, the dividend yield is at 0.91. So right out of the gate, we know their payout ratio is favorable. So some important numbers to look at. Now, proprietary numbers within the VectorVest program, dividend safety is an important one. This is the one proprietary indicator in our program that's not on a 0 to 2 scale. It's 0 to 99. So anything above 50. Okay, anything above 50 on the dividend safety scale is going to pretty much assure you that earnings per share versus the dividend, or the earnings yield versus the dividend yield, is going to be favorable. And so we look at that very closely. you'll see not all the stocks will fall into the dividend growth or earnings growth rate that we want to see. And in fact, apparently the Kraft stock may not have performed well from a standpoint of capital appreciation for Berkshire, but it certainly pays out over a half $500 million per year to Berkshire Hathaway based on the amount of shares. Bank of America actually is the highest payout in Berkshire Hathaway as far as dividends. If we analyze, that one, we'll look at an earnings growth rate that is favorable. That's percent per year. We'll look at an earnings yield versus a dividend yield, and the same with earnings per share versus the dividend paid. And the dividend safety is very strong, and the dividend growth rate. Right? So these are the things that are very important here when we talk about the dividend portfolios that we like to create here at VectorVest. Coca-Cola is one of the dividend aristocrats. I believe 60 years and running right now, Coca-Cola has not only paid, but has grown their dividend every year. And this is a huge holding for Berkshire Hathaway. So that's how we would analyze Berkshire Hathaway's top dividend paying stocks. All of the dividend safety numbers, with the exception of Kraft, are there. The dividend growth and the earnings growth are all there. Right? So Kraft is a dividend-paying stock that would never find its way into a VectorVest dividend portfolio. But these others are very good. So that's just kind of an introduction to how we do it. What I'd like to do now is go into what we call the Unisearch tool in the VectorVest program. And I have the ability to come in, and I want to share with you how easy it is in the VectorVest program to find good quality dividend paying stocks in our program. And then I'll show you the positive outcomes that come when you create an actual plan or investment plan with risk management techniques to not only build your net worth through capital appreciation in these quality stocks, but also with the income that comes with it. So in the Unisearch tool in VectorVest, we have the ability to create searches or scans to be able to find stocks that meet very specific criteria. I created this search with the idea of it being very basic, right? With the idea also of good quality, mature companies with a strong cash flow and a history of growing their dividends. It begins with the stock watch list within the program. So the stock, just to make this list, has to come from the Dow Industrials, the transports, utilities, or the S&P 500, right? Again, we want large, mature companies with a long history behind them. Stock dividend yield has to be greater than or equal to at least 3%. Now, I know a lot of folks will go out chasing high yield dividend stocks, and it's not the way to build a quality portfolio by doing that. Generally, the higher yields, sometimes they'll be very high for reasons because the stock price has been beaten down. You look and you compare earnings growth to dividend growth and their earnings, and you'll see that it's just not worth the risk to do that. So we want the yield to be at least 3% or greater to make the list. We also have the ability in the VectorVest program to use what we call the DRIP, or the Dividend Reinvestment Plan watch list that we have created here in the program. And we have watch lists of stocks that not only have, again, paid, but have grown their dividend. So we have the 10 to 24 year watch list, meaning that every stock on this list has grown their dividends at least for the last 10 years. And then we add the DRIP 25 plus, where stocks like Sherwin-Williams and Lowe's and Target and Coca-Cola have grown their dividends for years and years. And then finally, we make sure that stock dividend safety number is greater than or equal to 50 on that 0 to 99 scale. So that's how we break down the list, and we want those stocks to meet that criteria. If I break this down, we'll get just a sense. Now, remember, the market, it's not the time to buy now. As you saw on our homepage, we're not building portfolios, right now as I present this, but just, keep in mind that we keep market timing in place, and I'll share that with you as we go in to actually building the portfolio and some of the results that you can expect. So when we come in here, first of all, you'll recognize, I'm sure, all of the stocks that come up on the list, right? So I've returned simply the top 20 stocks on the list. You can go further out. And in fact, in the Unisearch tool, there's a great way to sort these stocks. There's earnings growth rate times the dividend growth rate. So that best combination brings these stocks to the top of the list. Okay, I can continue to scroll over and we'll come over to that dividend information I was talking about. Now, right now we have some sell-rated stocks here. Again, we wouldn't be building based on market trends and market timing, right? In the risk management techniques of building this portfolio, we certainly wouldn't be doing it now. But right out of the gate, you can see the top stocks. First, we start with earnings growth rate, because a company cannot continue to pay their earnings if they can't pay their dividends if they can't continue to grow their earnings. So we look at the dividend versus the earnings per share. Right? I can do that so it's easier to compare, and we'll see earnings per share outshine the dividend paid, giving us a favorable dividend payout ratio for all of these stocks. The dividend growth rate for the top stocks are all great in double digits. That's what we want to see. Right? And the yield, again, just to make the list, has to be at least 3%. Finally, we have what's called the YSG, the yield, safety, growth. That is a vector we use using the dividend, yield, growth, and safety numbers in the VectorVest program. Right? So we know that on a 0 to 2 scale, these are all favorable as we take a look at them. Okay. So this is just a quick way, or introduction to how we rank and analyze our dividend stocks, the dividend growth stocks. And if I could just share with you quickly here, I can show you a dividend growth portfolio. Now, this goes back 8 years. This is something we use in our retirement course and our retirement coaching group that I created a while back. It begun as a back test, right? Where we ran a back test, I think, for a couple of years, and I converted it into a model portfolio. So now it's managed in real time. So over the last 8 years, we're up over 182.5%. Now, the thing about this portfolio is, let me just remind you that this does not include the dividend payouts. This is just the capital appreciation. Okay, for this particular portfolio, there's roughly $60,000, or actually probably more by now, of dividends paid, and that doesn't even include reinvesting those dividends. Okay, this started as a $100,000 portfolio. Now, we do reinvest in a way, because if I scroll over, you'll see that the average cost basis of the positions is up sharply from the original $100,000 portfolio. 10 positions, 10 grand into each position. Now I've got it at, as we reinvest the cash that came in, we're able to grow those positions. So you're looking at a portfolio just in capital appreciation is up over 182% as we speak, not including the dividend payouts that have come, again, north of over $60,000 over that time frame. The other great thing to notice here real quick as I wrap this up is, yes, we see some drawdowns. There's no portfolio that succeeds, especially a prudent portfolio, without drawdowns. And this was the pandemic sell-off. We saw it back in 2018 in January and October. For those who don't remember, October of 18 was it was quick, but it was a drawdown. Of course, we had the September of 2021 drawdown that we saw here. But even in our retirement coaching group and in our course, we teach how to mitigate those as well. So what we're seeing here is a portfolio that, yes, while it has drawdowns, it's also a very safe portfolio. I admiringly call it a very boring portfolio because there's not a lot of activity there over the years, and it is very safe, not only capital appreciation, but you're getting your income as well. So just a great way to build and grow your portfolio using the VectorVest program. If you'd like to learn more about building and growing and protecting your retirement nest egg, you can go to VectorVest.com/3strategies, where you can learn about the 3 strategies to protect and grow your retirement nest egg. Okay, and this course that we have to offer is designed to help you build a system to grow your account, provide income, and most importantly to me, as we've seen in this current market, the ability to protect your net worth as well. Our goal is that you can retire with peace of mind. So in this course, you'll learn how to pick the best low-risk stocks to steadily grow your portfolio. You'll also learn the top 2 income generating strategies that you need to be using. And one of them I just talked about is a good quality dividend growth portfolio. And then finally, you'll learn how to protect your stocks and your entire net worth from these large drawdowns that we see in these volatile markets. So again, go to VectorVest.com/3 strategies, and I look forward to seeing you in the near future. Thanks for taking the time. Have a great day.